So I call this meeting to order. Just as a matter of bureaucracy, we do have a quorum. Good for us. I don't think I want to read the disclaimer. So what I think we'll do is we'll just go straight to review and approve of previous meeting minutes. I assume everybody has had a chance to review the minutes. Any comments?
Good with me.
They're good with me. Motion to approve.
Motion to approve?
Second.
Second.
All in favor?
Aye.
Aye. Okay, so passed. Review today's agenda. Everybody again has had an opportunity to review the agenda. Any comments or changes?
No.
No? I'd like to make one observation. I'm not suggesting we change the agenda. It says discussion of HSV investment options with village bankers, which I believe are our guests. Just to clarify things, this is my understanding that from reviewing Gary's original email from the board, the original issue was a comment in the audit report that said $11 million was, quote, unprotected. So I think the issue is both investment options and the concept of unprotectedness.
Right.
Okay, so thank you very much, Gary, for affirming that. So I mean, we're going to discuss, at the end of the day, whatever we want to discuss, but I think first off, just a little bit of clarity about what we will be discussing. So with that, I'm looking for a motion to approve the agenda.
So moved.
Second,
Second?
all in favor?
Aye.
Aye. Okay, very good. With that, I would probably ask Karina to introduce our guest.
Did you get that notification?
No, I've been in meetings since 8:30. I'm sorry.
Zaka cannot make it, he had a family emergency and will not be able to come on, so it's just the two of us.
Oh, okay.
So you're good.
So this is Karen. She is our commercial banking representative with Regions. And she has got Nikki,
Nikki Reynolds.
and I'll let you kind of take it from here.
Sure. So I am the commercial banker that is assigned to the Hot Springs Village POA relationship at Regions Bank. I'm also the market executive for this area. And basically, we have been working with you guys for several years. However, we don't currently manage your investments. You do have some stuff that is managed through us as an agency, but not on a large scale. I know historically we've had some conversations around what it would look like, your current investment policy, but we have not come out to kind of do any investment discussions, and which is why I wanted to bring Nikki out. Nikki is one of our specialists, and I'll let her introduce herself. But what we really need to do is better understand what your current situation is, what you're looking to do, what funds you have out there to place, and just learn a little bit more about how we can best help you. We do have some ideas that we've discussed in preparation for today, but also being here in this forum will be essential to really us understanding a little bit more about what's going on. So I'll let Nikki introduce herself and what she does.
Okay, again, it's Nikki Reynolds, and I work in the Private Wealth and Institutional Trust Group, and I manage the investments. So I work with, in the institutional side, various municipalities, cities, and then obviously corporations, nonprofits, et cetera, helping them to manage anything from their pensions and 401ks all the way over to their surplus funds.
Very good. Okay. Not exactly how to proceed from here. Karen, I think you started out by saying you want to better understand.
Yeah,
what
so
our
you
needs
mentioned that you had 11 million in non-covered funds. Are those investable funds, or can you give me a little bit more discussion on that?
Unfortunately, I wasn't prepared to show you my personal view of our, what we call our cash position. And our cash position, I'm gonna start shooting numbers just pure off my head.
It's okay.
Starting from the bottom, we have roughly $600,000 or $700,000 today, more or less, in something we call a golf reserve fund. It's specifically funded by golf surcharges starting about a year ago. And it's supposed to be, in my opinion, and there's nothing in writing that I know of, dedicated to capital improvements for our golf courses. And this is a fairly new. Then as we work up, I think we have very round numbers, about 2 million in our public utility reserve funds. And these have been building up for about 4 or 5 years, very roughly. Very roughly the same number, roughly 2 million in our non-utility reserve funds. So these are just for any purpose that we want other than our utilities. So when we say utilities, we mean specifically water and sewer. Then the next going up, it's pretty stable. It's $600,000 or something like that I forget the term we use. It's set aside, the protected stuff. It's the stuff we use for because of we owe money on bond interest, and we owe money on the unemployment, stuff like that. It's money that we absolutely positively can't touch.
Restricted funds.
Oh, you got it, okay. And then our biggest chunk of money, well, we also have something called an operating reserve, and that's about 1.5 million. And then finally, the big chunk of money today could be as much as $8 million, and that's just operating reserves. The biggest chunk of that is the $3 million PPP loan, which has been forgiven. And so at this point, it's just our money. We can theoretically do with it whatever we want. Now, as far as I know, the only part of that that's actually invested is the $1.5 million of operating reserves. And I think it's all in a ladder of rolling CDs, I think. One of the things that I think would be helpful to us is for me not to just sit around and spit numbers off the top of my head, but having a formal report saying, here are these categories of numbers and where are they being held and what do they look like. Just last board meeting, we passed a resolution that created 2 more funds, and that's just called a utility capital fund and a non-utility capital fund. And I think that intent is not to be a reserve. The reserve is sort of for emergencies only. That money is, once it's set aside, then we know it is dedicated to our capital. So it's actually taking a big chunk of our operating reserves, sticking it and saying, this is for capital. And so, to me, each of those chunks should have some kind of a philosophy dedicated to that chunk, and then maybe we can decide what it should look like and burn through all the different issues that, whatever the issues that we happen to have, how it's invested, how long it should be, and we still have to go back to the issue of safety. The thought that of the, right now I think it's 14 million in total. The 1.5 million, as long as they're properly structured in rolling CDs, those should be insured. I'm not sure what the insurance coverage of the remaining 10, 12 million is. The good news, if there is a good news, is that typically over the year, as we just spend money, all those dollars should go down, generally speaking. Not quite, but I mean, there's all kinds of exceptions to that. But again, to me, and this is just me, this is the first time we really discussed it, you have these 7 buckets, and each of them have their own unique point of view, and then we'll devise its own unique strategy and parameters. So I am perfectly happy to welcome anybody to add what I just said, and then we can discuss what your point of view is, so
And I
before we.
would think from your standpoint, the liquidity needs of each of those would be the most important criteria.
Yeah.
And this is shooting from the hip. Corina can correct me, as she often does so politely. But the golf reserves, I would say 6 to 12 months, we could probably give notice. Something like that. I don't know, but that would be my guess. The public utility reserve, possibly, in the event of a disaster, I'd be comfortable with 12 and maybe longer. That as long as it wouldn't cost us too much to get out of it if we had to in an emergency. Same with non-utility reserves, those are emergency funds. Again, this is just shooting from the hip, as we say. The 600,000 restricted for liabilities, that sounds like that's for short-term liabilities. So that'll be replayed quarterly.
So,
It's kind of money market is about the only option open, possibly. Maybe you have those ideas.
I'm gonna.
Am I stealing your thunder? Yeah, you go
No.
with this.
But I wanna add to it, so I apologize, I did not get the list of all our accounts out to them prior. Okay, so that's part of where he's saying he's shooting from the hip, so that's my fault. Which I do have the breakout here and I will email it, I promise. So what he's kind of talking about is in our operating cash is our large operating account that we have along with our payroll account, credit card clearing and press cash funds, so all of those that end up going through there. Then we have our restricted cash, which is a lot of the other accounts that we have set up with you guys for our dental fund, our POA, work comp, insurance, escrow, all of those. So those are where it is restricted. Some of those we're constantly putting money into to cover the bills that are gonna come out, dental and so forth. Some of the others we don't touch hardly at all, other than whatever's going on within our bond and stuff like that. So that operating cash at the end of May totaled 8.6 million. Our restricted cash was the 701,000. Then we have the operating reserve, which is the Cetera investment of the 1.54.
Oh, this is the Cetera that we have currently.
Yes.
Okay.
Then we have public utility reserve of 1,288,000 and the general reserve of 1,934,000 and the golf reserve of 576,000. Now, I believe those three accounts are what we have switched over to a money market as a beginning of 2020, I believe, when we had done that. Somewhere.
We don't have that, it's in a standard money market, right, not in a sweep?
Correct,
Right,
standard
okay.
money market.
Mhm.
So, coming back to the question that was posed in the beginning was, we've got all of these funds and not all of them are FDIC insured. Obviously, if we're sitting with roughly $8 million in our operating account. So I think that's part of where the question arose of how do we secure them? Which is where personally I was wanting to find out more about the sweep account, which is what we've discussed before, because we need the availability to those funds on a daily basis. The sweep account gives us the same access we have now, but allows it to be swept out overnight and invested, which then secures our funds as far as the FDIC ballpark. Am I understanding that correctly?
Not entirely,
Okay.
but we can get into that a little bit more. And right now, the economics are not great on that sweep, so I don't have people doing that. Now, last year, it was, the rates on the market had gone down significantly, and I'm not the expert at that, Nikki, so I'll let her speak to that. We're not currently doing we had in place when we originally talked about that, the Morgan Stanley and Fidelity sweeps, and we're not currently advising people to do that, and that's on a smaller market scale. But the funds that you're talking about at that level would be more in Nikki's realm, so I'll let her speak to that.
Well, I have some broad thoughts first. You've thrown out the numbers and the different things. That is so normal of any city, and that's exactly what they do. They structure an investment policy statement that talks about the various securities that can go in each of the accounts, and then they keep those separate accounts, various names, and then they structure the time frame around how long each one of those funds can be invested. So that part, you're on the right track about how to do that. And then as far as the rates, as she alluded to, unfortunately, I mean, if you want a mortgage, it's a beautiful time to be dealing with these interest rates, but as far as investing, it is very challenging to come up with anything right at the moment. We're talking about like 10 basis points for a year CD. It's a paltry little number. So having that structure in place about the idea, if you say, like you said, you may need some of the money in 12 months, if you can, especially during the east times, figure out, okay, if we had half of it in 12 months or less to make us feel comfortable, if we had to make a withdrawal, could we go out a little bit further to try to extract some sort of return? Now, in a couple of years, hopefully all that dissipates and you can, be invested in a 1 to 2 year time frame and get something more attractive, but right now it's very challenging.
And we'd also need to look at the interest rate cost, because with interest rates this low, I personally am loath to tie something up for 2 or 3 years to get another 0.1%. And my thought is interest rates are going up at some point in time.
They are.
Wait for that would be my thought.
Yeah, well, you do have to go out a little ways because we've been chanting that mantra for about a decade.
Yes.
Rates will have to go up, and they finally did, and it was very short-lived, and then they retracted again. The government has a lot of debt to pay off, so they're not going to be excited about raising interest rates. They don't want to slow down the economy at all. So they've given us a time frame. I don't think that they'll be, I know there's hints of inflation that make you think that there's a possibility it could go up a little bit sooner, but I do think they're going to slow play the rise in interest rates. So it's one of those where basically all you can do is ladder. I definitely would not advise going out, especially for these type of funds, like 5-6 years, anything like that. But I think you'll have to go out 1 to 2 years. Like there's a big difference right now between doing a 1 year and an 18-month. So if you can go out a little bit further and pick up 5 extra basis points in this type of environment, well, it's a small number, it's a large percentage increase. So that would be the thing. We just need to get as precise as we can about those needs, because if we can extend the time frame around which they're invested, that would be helpful to you.
And I think that's part of what our discussion was and why no changes were made last year, is we did get together and review things and see what our options were. And it wasn't cost effective for us to switch, at least to the options we were looking at, because it was gonna cost us more to maintain that type of an account versus what any return we would be getting at that point.
Well, and what I heard too is the concern around the audit report and the FDIC coverage. And that's kind of a different discussion than, what we're talking about with investments. And you actually stop me if I'm incorrect, if I say something incorrectly, because I'm not a CPA, cannot advise you as such. That's kind of a CPA discussion for you guys to have, but, the FDIC coverage covers entities up to a certain dollar amount, right? And that dollar amount is,
To 250,000.
250,000. And that's per entity ID. So, and that can be in different types of vehicles. So it can be over 250 in one institution, but it has to be kind of structured in a different way. Now that's internally at Regions or internally at any financial institution that you may work with. There are ways through what she does to put it at other institutions where you get that lift at multiple institutions. So you're getting that kind of coverage. There's also different types of vehicles that are collateralized that have, different levels of risk associated with it. I will tell you that that is a standard statement that I see in CPA reviews on a regular basis with any entity that has more than a certain dollar amount in investments capability, because that is just a call out that they do have to put in there. And you kind of have to determine what your risk level is at that. So I wanted to just clarify that those are kind of
Yes.
2 different discussion points.
2 different discussion points, but I think if we could marry them to achieve both the investment side of things along with the security and risk factor side that goes along, can just kind of overall what are our options.
Right.
And as he mentioned, we are going to be setting up 2 new accounts
Okay.
for capital. We do hope that those will grow. We'll have to structure a plan as far as, feeding into those each year. So part of all of that is how do we decide, and I know this isn't particularly on y'all's part, but us, is, you know, we've got our reserve accounts, and I think we're kind of all in the same flow probably, that we would like for that to be more of a contingency account for if the tornado came through or something like that, not something that we're gonna be dipping into a whole lot. So, some of them we will, some of them we won't, and are we utilizing it to the best of our ability at this point?
And I think that's really important. I think understanding what you need from an operational standpoint on a day-to-day basis and separating that out from your operating account and into a pool of money is always gonna benefit you if you can pool those funds and, you know, utilize a larger amount of funds that you're pooling, then, and you also limit your liability, the opportunity for fraud to happen on an operating account is the best way I can say it, right? Which is, you know, you don't wanna keep everything in an operating account that has a lot of turnover, unless that's what you need to exist. And I would say, one thing that COVID has taught us is that you do need to have some liquidity within, you know, within your quick grasp for at least, you know, a three-month period, I would think.
This may be a dumb question, but there was a lapse. Is it possible, or would it be advantageous if we set up something like what amount on deposit or invested in Regions would there be? And if we went out for a little longer term, what type of possible arrangement might there be that if we needed it short term, we could get a loan at, should it be guaranteed, you know it's there, at something
Yeah.
either related to prime or under prime?
We do collateralized securities-based loans. I would have to check on it for an institution, so I do know it's plausible, but I would have to get the thoughts around the amount and what that would be based on as far as the rate. It generally is, I mean, I know how it works a little bit better on the private wealth side. It's an interest-based only loan, and usually people use it as a bridge until they find a more appropriate long-term solution. But I can check on it for the institutional side and see what we could do. But I do know for sure that they do those. I just am not as well versed in the.
It seems to me that it'd help us with planning a policy.
Okay.
Especially in the time frame standpoint,
Yes.
of
Yeah.
what kind of time frame we're looking at. Because like you said, if we can stretch out just a little bit further, then we get a little bit more return.
Absolutely. And it's one of those, it's a short period of time where this is the conundrum, and that's, you know, you've got these excess funds, and usually the rates are high enough on investments to clear the fees. That's the problem we're having right at the moment. So it may be one of those where we have to kind of chew on our lip for a little bit, with the end result putting you in a much better place. You know, having those longer term investments, making more money to build on what you already have. It's just that centerpiece right here that we're dealing with where interest rates are so low, they're having a hard time clearing fees.
Would that include the participation with other institutions that you mentioned a few minutes ago for spreading the deposit insurance?
Well, what we do on the investment side is we buy brokered CDs. And so I've actually built before, this took a long time, it was like crawling to the moon, but I built an $18 million portfolio with $250,000 at every bank with a CD to meet the time frame for a building fund that they had in place. So that's how we do it. We just go out and we buy these brokered CDs. They trade just like a bond. So it's one of those, if you ended up needing the money earlier, we would just have to sell it. It's not like you have to go to a bank and pay a penalty. It would be more a little bit of a market valuation issue. But that's one of the approaches that we do, is we do the CDs for you. Because if you go out and try and manage it yourself, you know, you're dealing with multiple
You're right.
institutions. Where if you put it with us and we go out and buy those brokered CDs for you, we're the ones managing that process.
This is more an internal question, but how much flexibility would there be on, okay, we've got a Gulf Reserve, utility reserve, non-utility reserve. If we went out for different liquidities, can they inter-borrow, if that makes sense? We need it for public utilities, but that doesn't come due for 2 years. Non-utilities, we're not spending it on that, but could public utilities borrow from non-utilities with the payback? Am I making any sense?
We've done that in the
Is that
past, right?
possible?
I'm gonna go out on a limb.
But that's probably,
Well, I
Not a
mean,
good
it's a
idea.
I
guaranteed
think we were
thing.
trying to get away from that.
Well, I know it would be advantageous, but if we can gain an extra 5 or even 10 basis points, seems to me it would, it might be advantageous to add that in somewhere. It's not nice, but I don't think it would be impossible and gives us more options, I think. Is
I'm
that-
gonna go out on a limb and say right now, we don't have any rules.
Okay? But we can write them.
I mean, is that a fair statement?
We have the investment policy that is out there.
Right, but
But that deals primarily with just liquid.
It's
liquid
pretty broad.
stuff.
it basically says we will establish these funds.
Yeah.
That's about it. Now you're talking about how are we going to structure, operating or running them, and I'm not aware that we have any rules. I mean, we would require going back and rereading the policies and seeing what's in there, but I never got the impression. I mean, to a great
I did
degree,
not
this
see
is,
it in
the-
what we
Yeah,
have.
I believe they were just set up as reserve funds. They
Yeah.
weren't, it wasn't tied into, hey, is there any return on investment
Yeah.
and how to appropriate them or anything like that.
just for the benefit of our guests and maybe even us, we do have an investment policy, and the thing that I remember from it is, it says a lot of things, but it says the 3 most important things, presumably in this order, are safety, liquidity, and return. And there's no description on how far return is below or close to the first 2. I know that when we initially discussed it in the draft phase, I think return was pretty far down the list. The safety and liquidity was much more important, but it doesn't say that in the policy. Also in the policy statement is what we're allowed to invest in. And I think about the only thing that we really invest in is CDs. And of course, we have checking accounts and, sweep accounts and money market accounts, I guess. I don't know how new the money market account thing is, but we really don't have what I would consider to be a professional short-term portfolio. I mean, we don't have overnight money and
Correct.
repo agreements and all that really, sophisticated stuff. But that kind of was a really quick and dirty summary of our investment policy. I don't know if you've had an opportunity to just scan it or read it or anything like that.
Yeah, we have looked at it,
Okay.
and we have some samples that we can share with you. I mean, the goal behind an investment policy statement, as you laid out, is to understand what the purposes are. And they're great for providing structure, but you also want to be very careful about the wording that you don't paint yourself into a corner. So it's good to have the guidelines, but not to be overly specific. And one of those things, when you mentioned what return was, you don't want to get into the goal of stating what kind of return you want, because, you look at the interest rate environment now, and you don't want to violate your own investment policy statement. So we've got some samples that we can share with you, and you can see if you want to work that into your own or build off of your own, and see if there's anything in there that jumps out at you as being helpful to you.
I think, I probably keep going back to the topic of safety. But from what I heard, your statement that the audit statement of, X dollars is unprotected is not unusual.
It's not an unusual
And-
statement. It's in almost every one of my large entity statements.
And pretty much people in our position where we have, multiple $1 million, it leads me to believe that they don't have a whole lot of options.
That's correct.
I mean, the option that nobody wants to do is to slice up all of your accounts into $250 million bits and have your money.
250,000.
Yes,
Uh,
and that can
and-
actually work against you, because if
Yes.
you don't have that economies of scale, the
Yes.
bank is really willing to be able to help you with your needs on your
Yes.
fees.
But there's no real obvious backup, plan B, because nobody else is doing it.
Right.
I think-
One question I do have is, does government money market funds provide any significant additional protection?
Oh, well, and 2 different money markets. So the money market that we work with on the investment side, most definitely. We have classifications for money markets. We have the treasury only, we have government ones that will go out and pick up agencies as well, and then we have more of a retail that's gonna do more in the commercial paper and things like that. So absolutely, there are things that you want to look for in a money market to match more of what you see in your actual investment policy statement. And your investment policy statement, given the nature of what you guys do, is generally going to be like CDs and treasuries. So if you look for a money market that's what they're utilizing to create return for you, then you're not only following your investment policy statement, but you're also helping with the safety and security of the funds.
Okay, now we're gonna talk about something that I have a problem with, because, I mean, I really don't know how it works. We have, let's just say, $5 million, doesn't matter, $1 million. We deposited with Regions Bank, and let's say half of it goes into a plain old money market fund and half of it goes into a government money market fund. And God forfend, something happens to the bank. My understanding is generally, well, that's bad. Is there really any difference in terms of where you stand, where we stand as a credit? I assume we're a creditor. I mean, we're getting into really, legalistic stuff that I just don't understand. Is there any, what are our protections with respect to money market fund A, the plain old one, the government one? Are we more secure one way or the other? Or because the bank, which I assume is really the custodian, do they really own the assets and we're just stuck behind all the creditors? I just don't understand how this works.
No, and I get it, and that's a good question. And though we work together, we're actually two different parts of the bank. So she can speak to the bank side and the leveraging of funds if you have your bank products. If you move over to the trust side, where we house the investments, while they utilize funds for leveraging and loans and things like that, we never own your assets. So if we went under, you would get a letter that said, where would you like the funds sent? If you have it over on the bank side and the bank goes under, that's where the FDIC insurance comes into play. That's a whole different scenario. But on the investment side, we never take ownership of your assets. They are never in Regions' name.
Okay. Then I have a question for Karina. Which do we have?
Right now, they're on the bank side.
Okay.
They're on the bank side because, right now, when we started pulling them all together, they were just in checking accounts. And then we decided that we would start trying to earn some interest on those accounts. And so we moved them into the money market account. But at the time, so I took over the relationship with the POA in 2016 or 2017, somewhere in there. And what we started talking about was the fact that the reserves were non-existent. Like, we didn't have a lot of reserves. And we started to try to build those up. It wasn't at a scale in which I could bring in a Nikki. Because what happens is when you go into the investment side, there is a fee, a management fee. And the amount of money that we were housing did not offset the cost of the fee. Now, what I always tell clients is, when you are looking at your exposure to any bank, you want to look at the security and safety of that bank, right? So you look at, like, we are a publicly traded bank. We're 13th largest in the US. So you can go out and see at any point in time our credit ratings, our financials, everything else out there. And you can see how much we hold on balance sheet and what we use those funds for. So that's all public knowledge. And I would say that anytime that you are looking at that, anytime you're looking at where you're holding your funds, that's a number one priority, is to know how safe and secure is that bank, right? Because of our size, we do have a lot of scrutiny. There's a lot of analyst reports out there. You can go out and kind of get some comfort level from that. Then once you get to an economy or a scale of size where you have the funds that you need to start investing and have even more security, that's when I bring in Nikki. So that's,
So
we've
what
been
is
building.
that scale?
That usually starts around $5 million in investable dollars.
And you said, I understood, but you said you have more protection with the trust side?
It's
Because it
different.
sounds to me like if you never take ownership, we're still, there's no protection, it's still subject to investment risk. I think that's the
Oh, well,
question
it's
you're
always
asking.
gonna be subject to investment risk, yes. So that's why your investment policy statement lays out what kind of investment risk you're willing to take.
Yeah.
And if you're utilizing CDs and treasuries, you're pretty well protected there. You move into agencies, and while they're not backed by the government, they are implied to be backed and usually are. Then, you know, if you want to take on additional risk, then you look at like a corporation, and then you put a rating on those. So that's how you control the risk element, is in your investment policy statement, stating what you're willing to take on.
To answer part of your question, regardless of what bank you're talking about, if a bank is deemed insolvent, FDIC is named receiver. They immediately make available your insured funds, whether you have one account or two accounts, depending on your size. Then you're issued a receiver's certificate for the balance. And as the FDIC manages the receivership, then you're paid in increments as the receiver liquidates assets. So it could be, you could eventually lose 25%, 60%.
I would say typically, in most situations, and this is just my knowledge of the history, so this is Karen talking, not Regions talking, but when you have a bank that goes insolvent, or you have one that's reclaimed by the FDIC, a lot of times they're bringing in another bank to back those receivables. So usually you have a sale that actually ends up happening, so somebody else is gonna take that over. Am I stating that right? I mean, typically you're not
Close.
the regulators aren't
By
usually allowing you to completely liquidate everything in your balance sheet before they come in and say, hey, something's going on here. They're gonna take over a little bit earlier. But I would say, I mean, it's safe, it's the best practice to look at those things. Usually your investment policy will state, we wanna make sure our money is placed with a bank that is this well rated or higher, right? And those ratings do happen on a very regular basis.
Just to sum it up, while there's always a level of risk associated with your funds being insured versus non-insured, the fact that we are going with the largest, or the 13th largest bank in the US with a profound history, when you start to discuss, okay, kind of what is our risk factor by being FDIC insured, in reality, it's pretty minimal. Is that a correct statement?
I would say there's always risk.
However, yes.
I would say that, you know, we are BBB plus, I think, rated, on the Standard & Poor's, or I think that's.
It would be the normal one, that would be the right scale,
Um,
investment grade,
so-
triple B and higher is
Right.
investment grade.
And so I think, you know, I've seen some investment statements I've seen actually call that out. We want it to be with this level bank or higher. And then if you see the bank having some trouble with that, you know, then that brings back in your investment statement. Well, are we with the right organization, right? And so, I cannot tell you what you should and shouldn't be concerned with. I mean, that's kind of something that you guys have to make that determination of. What I can say is that on the region side, we are a secure bank who is very highly regulated and highly credit risk rated. And so while I can't kind of advise you either way, just because that's not my role, I would tell you that we are a secure organization. And, you know, anything's possible, but.
And
we don't
because
see
of
it.
our size, I can assure you that the Fed is with us all the time. I think they have an office within our office, they just seem to be there all the time, and they do that with larger banks, and they are continuously monitoring everything about them to make sure, because obviously the larger the bank, the more US citizens at risk if anything goes under, so the larger the better as far as compliance and oversight.
Okay. I'm compelled to restate what I think I've heard.
Okay.
And we're back to safety. There seems to be two paths, the bank path and the trust path. I'm just guessing, but the bank path and the trust path probably have different levels of service and what the bank will do and what you need to do, blah, blah, blah. And also a different fee structure, which then leads to essentially, necessary size, critical mass, whatever you want. If we are concerned about safety, then it sounds to me like then we have to look at how does the bank structure service our needs? And there is probably a higher risk of protection, insolvency. But, I mean, in reality, am I really concerned about that? No. Unless, having lived through this, when the financial markets get into a feeding frenzy and the wrong one person, one guy takes over a bank, all the rules are off. As long as your guys, or whoever our money is with, are basically conservative, chicken livers, then we may not go to hell in a handbasket like I've seen more times than once in my lifetime.
Yep.
On the trust side, same kind of analysis. What services do we need? What do we have to do with ourselves? What can you do? And different banks will have different banking services and trust services. But it's not free. It may have a higher level of security, but there's a cost.
That's correct.
And the cost may be dollars, it may be people and what you do for yourself, and you might have to redo all of your, processes and all this other junk. But what I hear is we have an alternative.
You do.
Well, and I would just sideline,
Yeah,
part of your funds are always gonna be managed at the bank level.
yes.
Because from an operating perspective, from an accounts payable, receivable, merchant services, any of that stuff, I'm still gonna be your primary point of contact at the bank level. Now, how much of your assets we actually manage at that level, that's the question, right? And then what pool are you looking for us to more securitize, right? So, and I think that's really the question is, how much do we really keep on the operating side and how much do we
Move to the
lever
investment
and move
side.
into the investment side?
Okay.
And then associated with that, all right, so that's fairly logical, but, and you kind of gave us a raw number of 5 million is kind of when you really ought to be going over and thinking hard about the investment side of the house. All right, so then fee structure then starts to become just like you were doing on the bank side. What's the best way to try and manage this so that you don't end up paying more fees than you're actually, receiving in interest or whatever? So how does that look like on the investment side? I think we all kind of have an understanding of how the bank side works, but how about the investment side? Because now we're actually getting a service from you.
Right.
And you're gonna charge us for that, there's no doubt about that. So to make that make sense, you guys are saying 5 million probably starts to crest above the limit where we'll probably, even using treasuries and stuff like that, which are not making a lot, but they're still making a little bit, we kind of break even or something like that. Is that what I'm hearing, or?
That's correct. And what we do is, though it is a separate place, the bank looks at your relationship as a whole to figure out fees. So if I told you, I can throw out our basic fee structure, but you need to know that it's dependent on each client and what all services they have with the bank. So if we said on the institutional side, the minimum fee is $10,000, then like I said, that's just, basic, here's our list of fees type of thing. Then you're saying like $10 million makes it an easy, structure to base it off on. But again, with 5 million, we look at how much do you have on the bank side? What does that do to your fees on that side? And we work together. So it's usually one of those, what we do is we talk about what you ultimately need, put together a proposal, and then once we see what our proposal looks like and what you have left on the bank side, that's where we come up with the actual fee. But it is based on like a percentage. And if I just make it easy and we talk in simple terms, let's just say it's 1% of management. That's more of a private wealth number, but it's easy to work with. If we say it's roughly 1%, then you can see once a year, we divide it by 12 and take it out monthly, but you can see on an annual basis what it would look like. And the beauty of having an annual management fee or a management fee, asset-based management fee, is if it's our goals in line with yours. If the markets go down and your account balance goes down, well, we have less in fees. If your account balance goes up and we make money for you, then in absolute dollars, we make a little bit more. So That's the difference. On that side, it's more transactional based, it's service based. Ours is more of an asset management fee.
Okay,
And would you mind, and I'm gonna kind of get a little bit off kilter, but because we do have the 1.5 with the Centera investments, and I believe we got the 2 bonds that make that, I believe.
Yeah, I'm not, yeah.
And then we've also got all of our equipment is used as collateral. We have, the 1.5 million, line of credit that we don't use. So kind of how do all of those things kind of play into each other versus what we really have availability to and what we don't, because it's already secured somewhere else, or,
That's a big question.
I was like, I think we're gonna need to put some pen and paper to probably lay it all out.
Yeah, I mean, I can send you here's everything that you have with Regions and kind of what that looks like on our side. The way that you guys are currently structured, and I'm going off memory, but we have the Cetera account that is the securitized collateral for the revolver or for
Yes.
the bonds. And we also have the ACH and a couple other things that are in place. And you're right, to date, I don't think you guys have ever used the revolving line of credit. And the one thing I would say on that is, when we have a line of credit in place, I have to hold capital against that line of credit in case you use it. So not using it actually deters from that, because what the bank has to hold in reserve that I can't lend out to other people is out there, and that goes against the fees, and we typically just don't charge you guys a lot of fees on an annual basis. So I would say that we have a significant relationship out there that, but it all kind of works together, right? So you have the treasury management side, you have the deposit side, there's several different things, but all of that together does allow us to offset. So, I always say I like to think of it as a box. And in that box, you have a line, and the line has a dot in the middle of it, right? And the higher in that fees box you go, then you're paying me to do business with me, right? And the lower in that box, I'm paying you to do business with me, right? So being a for-profit entity, I can't have it way too far down, but because we have a relationship, we don't want it too high in the box, right? So we try to keep it in the middle where it's kind of, a feasible relationship for both of us. So what she's saying is that we take that box into account, and that box increases by what she is doing, and we still try to keep you right in the middle of that box. So I think to your earlier question of what you all have, I mean, I can't just encapsulate that in a discussion point, but I would say that what we currently have on the balance sheet side, which is on the bank side, we're sitting in the middle of that box. If we brought her in, we could, kind of re-establish what that looks like, but we would have to know how much she would be investing and what that would actually look like to be able to recalculate that box. Does that make sense? I know that's
yeah,
a
well, that kind of goes
weird
back to what
statement.
Kathy said up front. I mean, we've already kind of identified pockets of money and uses for those money that we believe are prudent, but some of those don't need to come to us immediately, right? Which allows us maybe to go over to your side of the house. But there's some that we have to operate day to day, so, and if we structure the balance, knowing kind of some of the guidelines that you're talking about, then I think we can come back to you and you can give us a proposal then that says, based on what you're seeing, this is what the fee structures will look like. This is what, access to funds will look like. This is what we could kind of be looking at on the investment side, and what we think might be a reasonable return. Obviously gonna change every day, but those are the things that we could do. And then we could also look at the security side of the house, which is, okay, so we know we got this much, but part of that's not covered by FDIC, we got this much, and there's a risk associated with the treasury, but it's fairly low. So we can then explain not only to ourselves, but to the community, here's what risk level we're taking on, and how much we're being charged to be able to take, to invest that way, right?
Yep. And I think too, also looking at, how you want to operate is really important too. Just because we're operating this way now doesn't mean necessarily we have to operate that way. There's a good part of safety and security in the revolving line, but if we don't use it, do we necessarily need it? Or, is that better managed? Is that taking away from my line to the point where, maybe we need to lower it, maybe we feel like we need to have this available to us in case of emergency, but we don't need this. Or maybe it needs to be more. I mean, I don't know, because that's a decision you guys will have to make, but just kind of understanding that, I think would be important as well.
Yeah, so if I could just read back to you on that last piece with
Sure.
with the revolving line of credit. What I think you're telling me, so don't make me put words in your mouth, but what I think you're telling me is by us not using it, we're probably actually penalizing ourselves. If we were to use it, we might be actually able to gain a little bit of flexibility in how we're using our money, okay? Because we're doing that. You might give us a little bit of a break because now we're using a line of credit, which you guys like. And we might be able to manage the money, therefore not have to do so much as what Kathy was talking about, which is slide money from one pot to the other because we're trying to do this, but instead use the revolving line of credit to move money back and forth, if you will, based on how we set up the policy, right?
Right. So in most cases, people who have operating lines of credit are typically using them to offset payables, payroll, things like that, things that are short-term in nature. The way that it's currently set up is you have a line of credit that's in case something happens, right? So I'm holding capital reserves based on that. Now, that is being secured by about $1 million, right, at the Cetera level, I believe, or is that the?
I think that's the
I think it's
CDs.
backing, is it the CDs
I
or is
think
it
so.
backing that? Okay. So we need to understand that structure a little bit more, and I'm sorry, I should have probably brought that with me. But what we need to determine is, are we utilizing all of our assets in the best way possible? And do we need the line of credit at the level that we have it? Do we need less? Do we need more? And what are we actually using it for? I mean, what's it really providing for us to have that in place, right?
Right, and I think what you're really also saying to us is that we in the past have used that line of credit as kind of our emergency buffer, which we haven't used. But now that we build up our reserve accounts, which are actually supposed to be our emergency reserve, are we using the line of credit the proper way?
Right.
And we can use the line of credit for the bridge and would actually reduce fees and gain investment potential.
Potentially, yes.
Well, I think that's kind of where you guys are getting at and wrapping it up, is if we've got 2 million in each of our reserve accounts, and if we know we're not gonna use those, but you've got a $5 million threshold that kind of makes it more feasible to switch over. And we know we're already about at our cap on those accounts, but if we were able to pull in a little bit more, go ahead and take those reserve funds, put them over on the trust side, and then maybe we would end up having to use our line of credit. I mean, I don't see us necessarily, as long as we're still safe on the others, but that's your safe haven in order to take the rest of that and actually invest it. But
And you just used 2 of the reserve accounts, but wouldn't we try to use all 3?
well, it depends, because I know that they've been talking about the Gulf Reserve a lot lately. So I'd hate to say we're gonna put it in there and then they decide to turn around and do something else
But
shortly.
we could potentially use the line of credit. I think even on the trust side, we can put some liquidity requirements in it. I mean, by choice of vehicle. So
Oh, yes, most
we could
definitely.
do that with a 6 to 12 month and use the line of credit to offset
Well,
that.
to
Am I
be
missing
hon-
something?
To be honest, your line of credit, like she said, is gonna be more of your short-term liabilities that you need to be doing. You don't wanna go out and fund a $500,000 project with your line of credit funds.
Well, unless you've got a reserve that's gonna pay back that $500,000 in 6 months.
Well, you're also gonna be paying interest and everything else, so I
Right,
think
you
you
just have
should
to
come
make
in.
sure the offset works.
Right.
Are you
Right.
earning more
Yeah.
than you're paying?
Right. Yeah.
So, and I think one of the things, at least for me, with knowing that we're having the 2 new accounts that we wanna start setting up, we know that these are accounts that we're going to be using often. because it is gonna be for our capital. We do spend about $4 million a year in capital when things go well. So part of it is these accounts that we do have that we know we're gonna be using, is there something that we can do to get a little bit back or to make it a safer account? You know, what do we have as an option before I just go and say, hey, open these 2 checking accounts? I think that's a part of where, at least what I'm looking for, along with our operating account that's already in place. And as you know, we typically don't carry an $8 million balance in this account. We don't. Honestly, there's been times in the past where we probably could have drawn on our line of credit, and we didn't. We've just held on to a check an extra couple of days till the deposits came in, okay? So this isn't our everyday situation, but at the same time, as we are trying to be much better about managing our finances, both the incoming and outgoing, I would expect that we should be able to at least maintain a higher level than we have in the past. So I think that's part of where, well, that's why we were looking at the sweep account and other options is,
Yeah.
so just kind of getting the generality without knowing all the details. Are there just some ideas that you guys might be able to throw out of, hey, this is kind of an area you need to look at? Or would you need a whole lot more information from us?
In regards to where you keep the funds, I guess I'm just
Or were
trying
you
to.
talking about the safety and security and potentially, you were talking about if the bank structures it in certain ways, it would add a little bit of FDIC insurance?
Yeah, I mean, there
Is that
are-
what you're referring to?
Yeah, I mean, I know if we open the 2 new accounts, that's another 500,000 that's insured. That doesn't equate to,
Not necessarily,
Well-
because it's based on EIN.
Yeah.
It's not based on.
yeah.
And I can
Bank
kind of help, I can't off the top of my head. But, I can go back and kind of research where those funds could be placed in order to make them a little bit more secure for you for that EIN.
But at the same time, we don't want that to hinder us, because if all of our operating expenses are coming out of the same account, I don't wanna have to have a spread over 1 million accounts, then I'm pulling it all back in so I can
Right.
cut everything.
Right, right.
So I think from my perspective, it's just, yeah, is there something, whether
Are they a
it's,
reserve for particular projects?
which ones?
These 2 new accounts that you're opening?
They are going to be set up for all of our capital projects, yes. So they will be identified projects that will be coming against the funds that are there.
So you're specifically setting them up for designated products now, or projects?
So for example, if we put in 1.5 million and we're gonna, and this is part of what we still have to do, and I want their help on, is to say, okay, we're gonna structure this so that we, somehow or another, we're funding X amount into this every year. We're only going to use X amount, so it's gonna be used all the time, but it's gonna be used for designated projects. So it does still need to be, cash available on hand, short term, and not tied up long term, but it's not just operating, if that makes sense either.
Well, most of those projects, from what I could see, we would expect to initiate and finish within 12 months. Now,
Yes, most of
I
them.
mean, the line items that I saw were identified for 2021.
Yes.
And how we're gonna operate those accounts over the long term, we don't know. I mean, this is a new concept, so there are no real rules around how many goes in, how many goes out, how we identify.
Right, and that's
projects
where I
and
was
stuff.
saying, that's
Yeah.
something for us to work out, but these are the accounts that we would like all of our capital purchases to take place through. So they're gonna carry a higher balance, as long as we're funding them as we should be. But we're spending $4 million on capital, so you're gonna end up with a nice, good chunk in there, hopefully. You're gonna eat away at it and then build it right back up. So I guess that's where I'm saying, do I just wanna open a checking account? Do I wanna open it as a money market account because I'm using? I think that's part where I would like a little bit more help along with then what are our options if we take our reserve funds and try to put them in something more secure.
Let me ask you a quick question. So you have projects. Do you currently have identified timeframes in which you're gonna be making disbursements?
As long as things go as scheduled, yes. They are required to spread all their projects throughout the year.
Okay, and are they typically like even, or are they chunky?
It can be both.
It could be even, okay.
It can be anything from a one-time transaction to 25 transactions spread across the whole year.
The reason I ask, and this is actually more in Nikki's realm than mine, but the reason I ask is because sometimes when we were working with public entities, they will have projects that go on and we hold their funds in a fund where we know that there's gonna be scheduled disbursements that come out. And what happens is, we know we have a 30-day window to clear those. They come out of that laddered CD or whatever it is, and then we put it into, so you're maximizing your amount that you're getting from the investment, but we know that that's got to get into the account by a certain time. But you're not holding it in that account. Because keep in mind, the smaller accounts that you keep are gonna earn less interest right now, right? And so a money market is specifically designed not to have a lot of withdrawal transactions. It is not a checking account, it's not a demand deposit where we're seeing frequent transactions in it, right? Not like an analyzed account. But that doesn't mean that we couldn't work together in the fact that she's holding your pool and you say, okay, this account needs to be funded at X amount of intervals by this amount, and then they can manage that for you. So they're getting the uplift of the investment and then bringing it in. Now, from a security standpoint, if you want to maintain that money in on the balance sheet side, and we maintain it, you're gonna have a lower interest earning, you're gonna have it there, but then you also have the FDIC risk, right? So you're gonna have risk either way, and it depends upon what your risk reward tolerance is, and that goes back to your investment statement. I know that's a really circular discussion, and it really didn't answer what you were asking me, but it's the best way that I can kind of, we'll set it up however you guys want it set up. And there are multiple ways to do that, right? So, and we can help you come up with that. We just need to know what your goal is
Gotcha.
and what you need, and then we can kind of give you some discussions around that.
And just to give you an idea, like I said, we do this for other cities in the state, and there was one last week. It's a large city in northwest Arkansas, and I have a spreadsheet, and each one of their accounts has the name on the tab, and we go through it every few months, and we say, like, this account has $1 million whatever in it, this is reserved for roads, just an example. When do you expect your next outlay? And so we decide, and then we talk about what the yield curve looks like and where you can get interest, and we, originally they were laddered through 12 months, but now you can pick up more going out to 18 months. Was she comfortable doing that? Because, here, the outlay of funds, so we work with them to figure that out. And if they're comfortable taking some of the funds and going a little bit further out, then we pick up some yield, but we check back in with them periodically to make sure that their cash disbursements are in line with what we were thinking originally, to see if we need to change up the structure.
Gotcha.
Going along with what Jeff suggested a while ago, maybe at the end of our discussions, we will come up with a shopping list, if you will, in the form of a spreadsheet with maybe a couple options based on what you see the cash needs are, so that you can give us a blended cost or cross-service cost, whatever you call that. So we will know the bottom line. I think that's what I interpreted.
Well, I mean, based on what you guys just said, I think that's exactly, kind of what the kind of thinking that we're trying to go through, right? So in this case, we're gonna have two accounts we're gonna do capital on, but capital projects are predictable, right? You got a schedule, so maybe it is, we put them over there, helps build us up above 5 million, but it's gonna be laddered out over time, and we're gonna constantly be putting money back into that to basically replenish it, right? But we're gonna have to have a relationship with you and regular meetings with you in order to kind of make sure that tracks and follows the schedule that we anticipate.
Unfortunately, it is my job as vice chair or temporary chairman. I've been notified that this meeting has to have a hard stop
At
at
2:00.
2:15.
Okay.
So I need to call the discussion phase of this meeting to an end. My personal summary comment is, I think the ball's in our court. I think we need to decide what
Can I
we
just throw one
need.
thing out? If
Sure.
we could get your examples.
Yes,
If we could
yes.
get, you know, some examples, errated or whatever, however you wanna do that for us, that would be helpful, I
Okay.
think, for us, for just how we would structure ourselves.
Okay.
Right.
And since we've got 4 minutes, I'm gonna use 2 of them maybe. For the minutes, and because I have the question, what is the Cetera Fund and how do you spell it? And a brief definition for lay people,
CETRA, and I'll let her explain it.
as in et cetera. Okay?
Yes,
It's not actually my product, so,
it's actually in between both our worlds.
yeah.
Okay.
I can explain if you
Yeah,
want.
it's, Bobby manages it, so I'm not.
Yeah, okay, so what it is we have the different divisions of the bank. The banking side, I mean, there's several divisions, but you guys are not gonna care about all the others, so we'll focus on these 3. So we have the bank side, and then we are the trust and wealth management group, and we usually deal with a higher, level of funds. We are management fee based, so we have another arm that is more like our brokerage division. And that is for somebody who might have a smaller size account, might not want management per se, it might be more of a stable account. And so it fits in between both of our worlds. And so in this instance, it's not us actively managing it, it's collateral for a potential loan. So it is being managed, but it's really just sitting still per se.
And
So
that's primarily our operating account, correct?
It's not.
No.
It's not.
that is to serve as collateral if you ever used your line of credit.
Okay.
It is sitting out in a fund held at Cetera, which is the name of the company.
Okay.
And that is, you guys can't use it because we're holding it as collateral, almost like if you had a CD that we were holding as collateral.
Right.
Okay.
Okay, in recognition of our time limitations, I would ask to go around the room for the committee members, any quick comments, and we'll start with,
I just did mine.
okay, Karina.
Oh, I'm sorry.
No, I appreciate you guys coming out.
Sure.
I'm sorry, wasn't very prepared in this, so.
No, we thought this was a starting off point. We did not
Yeah.
expect this to be you giving us a bunch of information and us be ready to give some thought. This is a fact-finding mission, so don't apologize.
Okay, because I think that's exactly what it is. We're trying to figure out where we need to go, so, and what our options are.
Jeff?
One, I think we get inputs from them, and then I think we can have a structured discussion about how we would want to do that. Then I think we do need to go back to them with, hey, these are some thoughts and ideas, and have a follow.
Okay. Gary?
Thank you for coming in. I know for myself, it's been a lot of years since I sat in a finance class. Even though we did, thank you for coming because I know things have happened since I was at school.
Okay. We have 2 guests. Any comments from my guests? No? Okay, I would like to echo the comments that I've heard with thank you very much. I personally have learned a tremendous amount. I feel very strongly that we have moved the ball forward. I'm not sure that we're on the 5-yard line or which 5-yard line we're on, but we definitely made a lot of progress today. I think I understand the issues considerably more. You've given us something to look forward to in your input, and we need to regroup at some point in the future. Our next scheduled meeting is the 2nd Monday of next month, July,
Can it be the 9th?
so
It'd be 12.
the 12th, okay. Other than that, are there any other final comments? Motion to adjourn,
Motion to adjourn.
second,
Should I say that?
okay.
I haven't had a chance to look at it.
Let us,
Me-
we'll tie it all together. and
Okay.
Okay, meeting adjourned. All right, we're
Thank you.
then- Thank you,
Thank you
we
for coming.
appreciate y'all.
Thank you very much.